Hey guys, and welcome to today's session. Today's session is one of my favorite ones to run actually, because we kind of go into a deep dive into exactly what is a Darwin. Now, if you're new to Darwinex Zero, or maybe you've been around for a while, but you still don't understand what a Darwin is, it's exactly what we're going to be exploring today. And we go into it in quite what's the word? Into some detail is what I'm trying to say. We go in quite in depth as to what it is, how it benefits you as a trader, and kind of the differences between your Darwin, which is a risk-adjusted version of your trading strategy, again, which we're going to go into in much more detail. But we'll compare the difference between your Darwin and the difference between your trading account. Now, my name's Kieran. I'm head of UK growth and business development for Darwinex Zero. I'm also a trader, and I have a background in data analysis. So trading is something that I love. It's something that I do every day still to this day. And being with Darwinex, I really wish Darwinex Zero was around when I first started to trade, because I feel like the values it instills, and more relevant to this session, the things that you can learn from your Darwin and from our approach to your trading strategy is revolutionary for a lot of traders. Now, if you don't know who Darwinex is a regulated asset manager. We hold 3 separate certificates of regulation. First is by the FCA in the UK. We also are regulated by the CNMV in Spain, and we're also regulated by the FSA in the Seychelles. We have over $100 million active on our platform in AUM. So that's from third-party capital, external investors, whether it be institutional investors or just smaller retail investors, which gets invested into our traders. And we also have over 10,000 active strategies or active Darwins on the platform. Now, the reason we call them strategies is because we do have some traders who have multiple Darwins or multiple strategies on the platform. All you need to do if you wanted to open a second account or a third account is just open a new account with a new email address. The reason I'm telling you that is because it's probably our most frequently asked question. Now, what is the actual point of a Darwin, and what differentiates a Darwin to your trading account? At the very base level, your Darwin will always be in a trade that you're in yourself. If you're long the euro dollar, your Darwin will be long the euro dollar. If you're short gold, your Darwin will be short gold. We have a proprietary risk engine which takes all of your trades and it adjusts the risk of the position or the exposure of the position to match a value at risk of 6.5%. At the moment, if this is the first time that you're hearing about this, I apologize. It is quite confusing, but as we go through the presentation, I hope to answer all of your questions, but if you do have any, just pop them in whichever platform you're watching this on. If you're watching it on Discord, just put any questions you have in the Discord chat. On the YouTube, we also have a chat, and on Twitter as well, or X as well, I should say. We also have a chat on there. So if I don't answer any of your questions as we go through, please drop them in, and I'll be happy to stop and kind of answer any questions that you guys do have. Going back to what's the point of your Darwin? First point is it's risk adjusted. So whilst you're trading your account and trying to develop and make, the best trades that you possibly can, you can rest assured that your Darwin, the risk is taken care of. So no matter how you manage your positions, no matter whether you make a mistake with position sizing or what have you, you know that you always have somebody watching your back, which is our risk engine. It's akin to working on a trading desk or an investment bank, hedge fund, whatever professional trading arena you can think of. You're always going to have a risk manager, a boss, a trading floor manager, whoever it may be. And the risk engine kind of replaces the need for that. It's 27 control over your trades. It makes sure that you're not over leveraging, and it makes sure that we standardize the risk across all of your trading positions. The second point is you actually are trading under Darwinex regulatory compliance. Now, any AUM that you attract and trade, you don't touch it yourself. So you will always trade the same account, which through Darwinex Zero is a virtual account. That's the account you're going to be trading on MetaTrader 4 or 5. But any AUM that you attract sits at Darwin level. Now, your Darwin is basically an index. It's like an index fund, but the return that's generated on it is driven by your trade. 2 seconds, my dog's barking. Come here, you. Apologies. So it's basically like an index. Okay. Now that index is operated under the Darwinex asset management license. So you can legally take investment without having to get certificates yourself. The reason we can do that is because you're a signal provider to us and we manage the risk because we have the risk engine in place. Now, the third thing that you get with the Darwin is a proven track record. So you can build a track record with a MetaTrader account or MyFX book or what have you, but it can't always prove that you're not gambling to create a return. Now, I personally, as a trader, I like to have both. I like to have my actual trading results verified, which I would do using a reputable broker, of course, like Darwinex, having it on my FX book, and then also seeing my risk-adjusted returns with a proven track record. Because you can compare the two, you can see, okay, do I need to improve because of X, Y, Z? Is there a big disparity between my returns from my risk-adjusted account to my normal account? Because often if there is, it can highlight sometimes that you potentially might be taking too much risk. Now, you might think that I don't take too much risk. I risk 0.5 or 1% per trade. But there's so many factors that go into driving the risk that you take to generate a return, which again is something that we're going to go on to in a little short while. I'm also drinking out of a Christmas mug. I've got coffee in this because all my other mugs are in the dishwasher, so don't hate. It's I know I'm a few months early, but it's the only one I had available. Now, as I already mentioned, your MetaTrader statistics will sometimes be different to your Darwin return. So when you're on your Darwinex Zero dashboard, you might see a return of 5, 10, 50%, whatever it may be. That isn't always going to align with your statistics or your return that you see on your MetaTrader account, for the simple reason for your Darwin is risk adjusted. So of course, if you're risk adjusted and your Darwin is basically trading half the size of what you trade, if you're up 10%, your Darwin's probably going to be closer to 5%. Alternatively, if you're trading at a value at risk of 3.25% and therefore your Darwin is trading at double the risk, let's say you're up 5% on your Signal account, your Darwin's probably going to be closer to 10%. So there will be a disparity between the two. The main factors that drive the difference is your value at risk. Your value at risk then drives the risk multiplier, which is basically the calculation of your position size compared to the position size that your Darwin trades. And that's where the difference is. So as I've already mentioned, our risk engine adjusts every single trader's trade size on the platform to maintain a VAR or a value at risk of around 6.5% per month across the board. Now, that might sound like a bit of mumbo jumbo, but in essence, value at risk just estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, again, that might sound like a bit of mumbo jumbo. So we have an example. If a trader has a value at risk of $1,000 with a 95% confidence level over 1 month, it means that there's a 95% chance that the trader won't lose more than $1,000 in any given month. Now, it's a bit of a bad example because the $1,000 should be 6.5% value at risk, but let's just say 6.5% VAR is the $1,000 just to keep the example, nice and easy. So the reason we have this is because investors will like the fact that they know their max exposure, or at least with a high confidence, their max exposure. They know that if they invest into a Darwin, 1 month, they're not going to randomly see a 50% drop in their equity, because with a 95% confidence level over a month or a 2-year period, we know that, our traders might see 1 month where there's a 6.5% drop over a 2-year period. So we can say that's probably the worst that you're ever going to see. Now, of course, there is going to be worse months. We can't always limit it exactly because this is trading, this is the markets, black swan events happen, traders lose control, all that sort of stuff. But this is just us mitigating the downside for investors. If that still doesn't make sense, feel free to ask any questions. I'm happy to go over it in more detail. But I'm also aware that when we try and over-explain these things, sometimes we make it more complex than it needs to be. Now, by doing this, by risk adjusting every single trader, it creates a level playing field, ensuring that every trader is based on their skill and not the amount of risk that they're willing to take. The way I like to think about this is It's like we're lining up all of our traders for a race. And the only thing we're judging you on is your stamina and how far you can run, not the speed of how you get there, right? We're making sure everybody runs at the same speed and seeing who lasts for longer. That's kind of the example I like to think of. So every trader is basically operating with the same level of risk. Now, with that level of risk, who can make the better return? That's the only really fair way to determine who is a better trader. Now, of course, you're going to have bad periods. Other traders are going to have good periods. But consistently over a long period of time, if you're both operating with the same level of risk, or I don't really like the word risk, I prefer exposure. If you're trading with the same level of exposure, but one trader makes 20% over a year, the other trader makes 2%, clearly for that year, trader A was far, far better because they made a higher return. They didn't take excessive risk. They didn't actually take any more risk than trader B because we leveled that out for them, but they made an 18% gain over trader B. So you can accurately say that year, this trader was better. Now, you might wonder why we use 6.5% value at risk. And there's a couple of reasons. The main reason is that the S&P 500's volatility is sat at a 6.5% value at risk. Now, we know investors are happy and will tolerate that sort of P&L volatility. We know that they can sit through certain amounts of drawdown. And so what we're trying to do is adjust everybody's trading strategy to a risk level that we know an investor will be happy with. Because the last thing that we want to do is push the risk tolerance of an investor. They get shaky boots and then they pull their funds from you. Doesn't benefit anybody. Doesn't benefit the investor because they're probably going to pull out at a loss. Doesn't benefit Darwinex because, you know, that's what we try and do. We're building a business to bring capital to you guys. And it doesn't benefit you because every time you go through a drawdown patch, your investors are going to pull their capital. Now, if we're capping that drawdown and we're capping their exposure, we know that an investor will happily sit invested in the S&P for 5 years, 10 years, 20 years. And now we want to replicate that for our traders. But as long as you keep performing, we want to keep investors there for you. And that's why we do this. We did used to have higher limit of value at risk. This is way before I started with Darwinex. So I don't know the exact figure, but I think it was somewhere closer to 20 to 30% value at risk. And we learn from our mistakes. So everything that we're saying now, or everything that I'm saying in this session, it's not just something that we've thought of randomly. It's through trial and error. Darwinex has been around for 13 years. We've learned a thing or two. And one of the things is we need to make sure that we keep investors happy. How do you keep investors happy? You provide them a return, you manage their risk. And that's why we use 6.5% now. Now, an investor can use leverage, and they can leverage up to 3 times. So they can increase their value at risk by leveraging up. But as a standard, we don't do that for them. That's completely on the investor. And, you know, it's their choice whether they take that additional risk. Now, going back to your Darwin statistics compared to your MetaTrader statistics, only you will be able to see your actual MetaTrader statistics on your Darwinex Zero dashboard. And whilst you're on the return versus risk tab, these will be your risk-adjusted metrics. So this is showing risk-adjusted metrics with the AUM that you're currently managing. If you was to click on Signal account, which you can see is actually grayed out here because it's only available for the strategy operator, then it would change your statistics to show your actual Signal account or your MetaTrader account statistics. Again, nobody else can see that. Only you can as the trader. I think on Darwinex, like Classic or Darwinex.com, I think you have the option to make this publicly available. But to be honest, you don't really need to. And investors investing into your Darwin, they're not investing into your Signal account. So it doesn't really make any difference to them. Now, let's try and get a little bit of a better understanding about value at risk. This is a chart that we use to measure your value at risk in an organic and, I mean, what's the word? I don't think organic's the right word. It's kind of a living, breathing metric or a living, breathing. No, maybe organic's maybe the right word. This chart will update in real time as your trading behavior changes. So if you start doing something completely different, if you add multiple assets or you start trading with bigger size, lower size, whatever changes you make, this will update trade by trade. It will constantly update. Now, You can see this chart is from May 2023 to October 2024. So it's about a year and a half's worth of data here. And we've made it easy for you to see. We've put the line on for 6.5% value at risk. Now you can see whilst the trader's trading above the level of 6.5% VAR, we've put some down arrows. That's basically just to represent that our risk engine will be taking your trades, every single trade that you take, and it's probably going to be scaling the risk down. Now, at the peak, it looks like it's doing potentially 13.5% maybe. That means the risk engine is probably going to be cutting your trade size in half. So if you're taking a 10 lot position, the risk, your Darwin's probably going to be taking a 5 lot position. Is that right? Did I say 10 lot? I think I did. And then you can see as the trader comes close to the 6.5%, the risk multiplier, which is the second metric that I was talking about earlier on, is going to increase. Because as your VAR comes down to 6.5%, your risk multiplier is going to close that gap between the size that you trade on your Signal account to the size traded on your Darwin. As they hit 6.5%, you're pretty much going to be seeing a 1-to-1 on your trade size. If you're trading a 10 lot on your Signal account level, you're operating at 6.5% at this specific period in time. So your trade size on your Darwin is probably going to be exactly the same at 10 lots. As they start trading underneath the VAR of 6.5%, the risk engine is actually going to be scaling their trades up. So we can scale up your trades without taking too much more risk exposure because you're operating at such a low level anyway. And for the rest of time until October 2024, in this specific example, the trader's trading underneath the VAR of 6.5%. And therefore, for that whole time, their risk is going to be increased by our proprietary risk engine, only at Darwin level. Now, there is a function. And again, this is only something that you can see on your own Darwin. So you can't go onto somebody else's and take a look at their metrics. But we have a Darwin Live Trades tab, which is why it's private, because we protect every trader's IP. We don't let other people see the trades that you're in until after the fact. And even then, the majority of the information is protected. But you can see exactly how your trades are being risk adjusted. So you can see your Darwin risk in this example is 2.32x. Now, this would tell me that the trader is probably, I don't know, trading at 2% value at risk, maybe 2.5% value at risk. They're definitely under 6.5% because they're actually being scaled up. So you can see they're in a trade, New Zealand against the yen, or New Zealand dollar against the yen. They're in a short trade, sorry. They're traded 1.2 contracts and their Darwin's actually traded 2.79 contracts. So you can see exactly on a trade-by-trade basis what size you traded and how that's been reflected in your Darwin. We do have a current closure rate as well. So the risk engine can get involved in your positions. It doesn't happen very often, but if you start spiking your value at risk, if you start increasing your size when you're in drawdown, for example, a martingale system is the perfect example of when this would happen. And you're increasing your position sizing, your value at risk is going to keep increasing. And therefore the risk engine might go, this trader's adding a little bit too much exposure now. So what we're going to do is we're going to close some of his first trade and open only some of his new trade. So if a trader adds another 3 lots, we might only open 1.5 lots, but we're also going to close some of the initial exposure. That's the reason why martingale systems don't generally work very well with Darwinex, just because it's basically a conflict between what the risk engine's trying to do and what a martingale system is trying to do. One of them is trying to keep risk under control. The other one is trying to add risk to get out of a bad situation. Now, in this example, we've got 2 traders. Again, similar to what I was talking about earlier. Trader A trades with significant size. So they're trading with too high of a lot size. Let's say in this case, 20 lots per trade. And then we have trader B who's trading, too little size. And therefore their risk is lower. You could change the factor to be something completely different. Trader A could be trading a less volatile asset like euro dollar. Trader B could be trading a higher volatility asset like the NASDAQ or Bitcoin. And therefore they're going to have a different risk level as well. It isn't just position sizing, which we'll get onto in a moment. However, position sizing is probably the biggest factor to determine risk, of course. Now, for trader A, the risk engine is going to be scaling their risk down. So it's going to be going, you're trading with 20 lots, which is a value at risk of 20% or 30%. So we're actually going to take your 20 lots and we're going to reduce that at Darwin level to 4 lots or 5 lots, because that's the same value at risk of the S&P 500. Now, for trader B, the risk engine is going to be looking at their trades and going, actually you're quite conservative and you're not going to generate a return that's going to beat the S&P, especially at the risk level that you're operating at now. So what we're going to do is we're going to take exactly the same trades, but we're actually going to scale your risk up. So you might be taking a 1 lot position, but you can actually squeeze 3 or 4 lots without even touching the value at risk of 6.5%. So it's going to scale trader A down, it's going to scale trader B up. They're operating at the same level. Now let the best trader win, basically. The reason we do that is it ensures fairness and consistency across the whole platform, every single trader. So you can't say one trader's having or got an unfair advantage because everybody's operating with the same level of risk, and it updates consistently. So there's no way to game it because the risk engine, like I say, it's like a living and breathing organism. It's going to be watching everything that you do, and it's going to be updating based on your changes in behavior. Now, your strategy's value at risk depends mainly on 4 factors. Number 1, asset volatility. Again, generally speaking, the higher the volatility of an asset, the bigger the volatility or the bigger the swings in P&L you're going to see on your end. The bigger the volatility in P&L. And then number 2, number of trades / trade frequency. If you're trading more frequent, generally you're going to have a higher value at risk. And the only reason for that is there's more chance for things to go wrong. If you're trading 100 times a day as opposed to trading once per day, obviously there's more room for error. You're probably going to take worse trades as a general rule of thumb. I'm not saying that for everybody, but there's more commissions. There's, like I say, higher chances to experience a black swan event or to be caught up in volatility whips, or it's not a massive factor. In fact, I think it's the smallest factor, or one of at least, but it's still one of the factors that calculates your value at risk. Number 3, we have trade duration. So the longer you sit in a trade, again, the higher your value at risk is going to be. That's not to penalize swing traders, but swing traders will generally see more round trips than a scalper. By round trip, I mean, sat in a trade for 3 days, might pay all the commissions or the swaps, and then the trade just comes back and takes them out at break even or at their stop anyway. Also, again, you have a higher chance of sitting through periods of higher volatility or black swan events just based on having more exposure to the market on a time basis. And last but definitely not least, because it's the biggest thing that will impact your value at risk, and that's just position sizing. The higher your trade size, the higher your value at risk, period. It doesn't matter on anything else. Like, you could be trading the lowest volatility asset, you could be taking 1 trade a year, and you could be sitting in that trade for a minute. But if you're trading that with 1,000 lots, you're taking excessive risk. So your position sizing is the biggest factor when it comes to your value at risk. So it's something that you have to be very, very careful with. Now, if you're after this session looking at your Darwin and you're going, my VAR is pretty high and I want to bring it down, I would say, okay, but just do it gradually. So make sure you're reducing it slowly. Don't make any drastic changes where you go from trading 100 lots to 1 lot overnight. The risk engine generally has a 45-day look back period. So it's going to be giving recency bias to the previous 45 days. So if you can slowly spend a month and a half to 2 months, slowing things down, reducing size, maybe from 100 lots to 95 lots, 95 to 90, 90 to 80, 80 to 60, and slowly reducing it as opposed to just making a big change overnight. What you'll see is there won't be a big drop in your VAR and a big spike in your risk multiplier. It's going to do it gradually over time. Great question. So Victor in the Discord has asked a fantastic question. How does it take into account stop losses, for example, when I move at some point to break even? This is a brilliant question, Victor, and thank you for asking that. The risk engine doesn't look at your stops or your targets at all. It's only looking at your exposure to measure your risk. It's not looking at where's this trader getting in, where's this trader getting out. So it doesn't even take it into account. But I like your thinking. Now, just before we finish off, and we are back in half an hour, we've got another session with Juan Colon, the CEO of Darwinex Zero. We're going to be going over some future developments that we're working on, which I'm really, really, really excited to discuss. And then we're going to be having an AMA as well. So if you do have any follow-up questions, please join that session. And you know, you've got the chance to speak to the CEO of the business as well and ask him any questions that you may have about Darwinex Zero, me, Juan, anything that you think is relevant. But just to finish up this session, I'm going to be answering some FAQs that we generally have after these sessions or from people in general. So number one, when will my Darwin be listed? So we do have a calibration phase at the beginning of a trader's Darwinex Zero journey. Generally takes 3 weeks to complete. It's not a pass or fail assessment. It's just so that our risk engine can get an accurate read on your risk. After you come out of calibration phase, the following Monday, your Darwin will be created. So Darwins are created over the weekend and they go live on a Monday. So it can be any Monday throughout the month or throughout the year, I should say. Number two, should I stop trading while it's being listed? There's absolutely no reason to ever stop trading your account. Whilst it's being listed, any trades that you do take are going to be included anyway. So carry on trading it during that period. For example, if you finish the calibration phase on a Monday and it's not created till the Monday after, just keep trading for that week, because anything that you take is also going to be risk adjusted and counted in your Darwin anyway. The other time that I like to add to this, I don't think anybody should stop trading for the purpose of securing allocation. I can understand why people do it. If it's the last day of the month and you're on track to get 30K or 35K or however much it is, then yeah, fair enough. Maybe there's a reason to stop trading for that day. I just say don't take too much time off out of fear of losing allocation, because you need to have conviction in yourself as a trader. If you see a setup, always trade it, in my opinion. Nobody agrees with me with that, but it's in, you know, that's how I feel. Number three, should I increase or reduce my risk? I've kind of already covered this. I think the only time you should really consider reducing your risk and, you know, really give it some thought, if your value at risk is over 30%, generally I would say try and bring it down over time. And the reason being for that is because what we've seen over the past 13 years is that any trader with above 30% value at risk generally blows up at some point, whether it's 2 months, 2 years, 10 years, however long, or if they don't blow up, they see a significant period of drawdown. And, you know, that can wreck so many traders, even if they don't blow up their account. So just be mindful of that. Under 30%, I mean, 6.5% to 20% is the sweet spot. It's the happy spot. But I'd say anything under 30%, I wouldn't be too concerned. In terms of increasing your risk, I don't think it's necessary, because the risk engine is going to do that for you anyway. Number four, how to increase my risk multiplier. I've already answered this already as well. To increase your risk multiplier, it's like a symbiotic relationship between your value at risk and your risk multiplier. You would decrease your value at risk, so slowly bringing your position sizing down or trading less volatile assets, trading less, etc., etc. Doing that over time is going to increase your risk multiplier. So if you're bringing your trades down from 10 lots, let's say it's doing a 1 lot on your Darwin, as you bring it down, you're going to see it increase over time. Is it bad to have a high or low multiplier? Realistically speaking, there's no such thing as a bad multiplier, regardless of whether it's high or low. Again, the only thing I would be concerned about or be careful of here is if your VAR is over 30%, I would be very, very cautious. Going outside of Darwinex as well. I'm not just talking, you know, about this cocoon that we're in within your Darwinex Zero account or your Darwinex account. I'm talking generally. If you look at your value at risk and you can see you're operating at 35, 40, 80% value at risk, let's say, you need to go at some point. I'm going to see some, you know, real big drawdowns. And this goes into my personal account, any investor capital I've got, funding companies, Darwinex, and it can affect every trading account that you have. Because if you're trading the same way on your Darwinex account as you do on your personal account, you're going to see the same issues on both of them. So yeah, it's not bad. It's just be mindful of if your value at risk is too high. On the flip side to that, if you do have a really low value at risk and therefore you'd have a high multiplier, take that into consideration, because you could go onto your other accounts and you could know that you're trading with such a low level of risk and you could actually increase it. So for me, for example, I actually trade with 1% per position. So I do a pretty standard thing that, you know, we all know what to do, 1 to 2% per trade, what have you. But I'm still under 6.5% VAR. So my trades get scaled up at Darwin level. What that's done for me is know that when I'm trading my accounts externally at Darwinex or my Darwinex account, I'm at that low risk that I can still increase. I can trade 1.5%, I can trade 2% without fear of, you know, blowing up my account or going on an extended drawdown period because my VAR is so low. And I believe that brings us to the end. Oh, no, it doesn't. We've still got a couple more slides. So at the moment, we do have a discount code for all subscription plans. So that includes the monthly, the 1 year or the 3 year plans. The discount code is DWX10 and it will give you 10% off. And we also want to highlight our member get member scheme, because not many people know that we have this, and every single trader on our platform has a member get member code. Now with the member get member code, you can bring your friends, family, people in a forum, people in a Discord, whoever you want. People that you bring to Darwinex Zero, they will credit you a free month. So if I referred a friend, my friend would get a discount to their subscription and I would receive a 3 months subscription with Darwinex Zero. So if you've referred 12 people, you essentially get a year's worth or a year's free access to Darwinex. We do also have a partner program where we work with traders who have an audience and want to partner with us in a more closer capacity. So if you do want to explore any opportunity with partnering with Darwinex Zero, please just drop me a message. Discord is probably the best place to catch me. You feel free to just send me a direct message. I do try and get back to everybody on a daily basis. Sometimes it can spill over into the next day because my DMs often get flooded. Alternatively, we do have a partner email, so you can email partners@darwinexzero.com. I'll write that in the Discord. Zero.com. So if you did want to work with us in a close capacity, please just reach out and let us know. And last but not least, if you're not in our Discord, I highly recommend you to join now, because we do have a phenomenal community of traders, all in different languages. So we have a huge English audience in the Discord. We have a huge Spanish audience in the Discord. And we also have a French and Italian part of the server. So if you speak any of those languages and you enjoy talking about trading, please join, come and have a chat. You'll meet some fantastic people. You get to speak to the team. I'm in there 24/7. And we have some really great traders as well, so you might learn a thing or two. But guys, I'm going to leave it there because we are back in 30 minutes with a session for a session with Juan Colon, where we're going to go over future developments and an AMA. So come back to that session, get any questions answered that you may have, and yeah, we can have a chat then. See you all later, guys. Bye-bye.